This set of slides is a little bit longer than the first two, primarily because in the area of filing status and exemptions and the kitty tax, the three major topics you can see listed here, I've tried to provide you with several different examples to flesh out what's going on. There's a lot of material in this chapter that we're not going to be dealing with. Some of it talking about how to do tax calculations and stuff you already know because you've been doing tax returns since the very beginning. So remember, we have our tax model, AGI, the last number on the front of the 1040, deductions from AGI. Right now, we're only looking at the standard deduction. When you finish this set of PowerPoints, we'll move on to talk about deductions. Chapter 6 is primarily deductions for AGI, and it won't be until Chapter 8 that we get seriously into itemized deductions. And then, of course, our personal and dependency exemptions, which leads us to taxable income. The standard deduction depends on your filing status. So far, I've simply said you're single, you're married, you're head of household. Now we're going to delve into how you qualify for a specific filing status. And then we're going to talk about all those pesky $3,900. How many of them can you get? A personal exemption, that's the $3,900 for 2013. Indexed for inflation, so it changes every year. You'll want to make sure that you refer to the information I'm putting at the bottom of tests and quizzes where we have the filing information for 2013 so you don't get confused. The personal exemption is personal to the taxpayer and the spouse if filing a joint return. If you are dependent on another's return, that's our last major topic for Chapter 3, you are not allowed a personal exemption. And then there is that phase out. We have already dealt with that. The worksheet that's in the tax packet is back in play. So if your AGI is over $300,000, you probably are not going to get any exemptions. You're too rich. The CPA exam does test exemptions quite heavily. You should know that dependency exemptions are different than personal exemptions. The dollar amounts are the same, but if the CPA exam says personal exemptions, they're referring to those that are unique to the taxpayer and spouse if filing a joint return. If you are married filing separate and want to claim your spouse, you would claim your spouse as a dependency exemption. There are two basic categories of exemptions, dependency exemptions. The first is a qualifying child. We'll go over those requirements, but the major way that they differ from the qualifying relative is that you have to be under 24 to be a qualifying child, and there is no gross income test. And we'll see that for a qualifying relative, it quickly becomes difficult to claim someone if they have even $4,000 worth of gross income. And then the qualifying child is a requirement for some of the more lucrative tax benefits that are out there. So the first test to be a qualifying relative is you're not a qualifying child, and then there are some additional tests that we will go over. There are common requirements, whether you are a qualifying relative or a qualifying child. You cannot be the dependent of another taxpayer. So there is only one $3,900 to be had. You cannot file a joint return other than just to get a refund of everything that's been withheld. So your daughter graduates from college in May. There's a possibility, a pretty strong one, that she could still be your dependent for that year. If she marries her college sweetheart, it would depend on whether or not they are filing just to get their refund back. They both work summer jobs and they would have gotten their money back whether they filed separate or joint. Or the young man she married was several years ahead of her and is making a lot of money. Filing joint will almost always land up saving taxes over all the other filing statuses. And so if you are reducing overall tax liability, then the exemption has to be claimed on the married filing joint return, and daddy loses out, even if he did spring for an extra semester of school and a really expensive wedding. Can't be a non-resident alien. The United States essentially says anyone who has lived in our country for more than 6 months is a resident of the United States, and we will tax you on your worldwide income. Now, there are some treaty exceptions to that. If you are here as an international student, you are not a resident for the first 5 years you're here. And so if you are providing support for someone who does not live in the United States, who's not a resident of the United States, other than Canadians and Mexicans, then you cannot claim the person that you're supporting on your U.S. tax return. And then this is just a list of all those things that if you want these credits, you have to be a qualifying child. Not a subject for our course. Just bear in mind that the computer, when you're using software, will never give you these credits unless you have satisfied the computer that indeed the person is a qualifying child instead of a qualifying relative. Then the test for the qualifying child, first is the relationship. Must be the taxpayer's child, but you see that that's a pretty broad definition here of what would pass for a child. Residency test, child must live with the taxpayer more than half of the year. That's 6 months plus a day. Temporary absences are okay. And here's just a list of the various things the IRS doesn't hold against you if the kid's there instead of in your house. The age test, I alluded to that earlier. If the child is not in school, must be under age 19. If he is in school, can be under age 24. So if your son had a pretty rocky start in college, took a few years off, he's 26, and you want to help him get back into college, get back on track, you cannot claim him as a qualifying child, even though all the other rules are met, unless he is permanently and totally disabled. So he would potentially be a qualifying relative, which will get you that same $3,900, but it wouldn't get you any of those credits we alluded to earlier. Support test, this is a major difference from the qualifying relative. The child cannot provide more than half of his own support during the year. So your kid is making $10,000 modeling. If he spends that $10,000 on himself, you must have spent at least $1 more. And we will go over that more than 50% test when we get to qualifying relative. Because so many different people might be supporting a child, the government decided it would be easier if the only person you had to measure was the child himself. So it doesn't matter whether the rest of the child support is coming from grandparents or welfare. As long as the child himself is not providing more than half of everything spent, you're good to go. And way beyond our course, but for the earned income credit, they make that a little easier. This is once again a major difference from qualifying relative. So this is an area where you want to be able to make sure you know which test goes to which one. Then you can see here that the flip test. If you are going to qualify someone as a qualifying relative, you must have paid more than half of the dependent support. So if they're getting money from grandma and they're getting money from welfare, then you're going to have a more difficult time being able to claim them. And then this is just a set of rules. I'm not going to read them to you, but it could very well be that mother, daughter, and granddaughter are all living together, and therefore the child might be the qualifying child of both the mother and the grandmother. And so when that happens, they have a bunch of tiebreakers that are in the code. Once again, beyond where we need to be, if you get a complicated question, just get the flow chart out and work your way through it. So the second way that you can claim that $3,900 on your tax return is to have someone be your qualifying relative. 4 tests, the first of which is they're not your qualifying child. The second of which is the one that causes most people the most trouble. If the dependent's gross income, and having worked your way through chapters 4 and 5, you know that not all increases in wealth are gross income. If the child or the mother or the uncle's gross income is larger than the personal exemption for the current tax year, so it'd be $3,900 in 2013, you are totally done. No reason to go any further. So you spend $30,000 on your mom, but she's got $4,000 of bank interest. You can't claim her. So you would need to do something to have her have income, but not gross income. So perhaps you could swap out her bank interest for muni bonds, and that would give you an opportunity to be able to claim her. So all income earned by the dependent is what we're looking at. Whether it is wages or investment income, it all counts. If you survive that hurdle, the next is support. So support is basically everything you spend. There's detailed discussion in both the book, and if you've gotten your Pub 17 by now, you may find it very helpful in these areas if you get a messy little question. So the one who's trying to claim the dependent must pay more than 50% of the support. So it's all money spent, including the government. Doesn't matter who ponied up the money. You're supposed to keep track. The last requirement is a member of the household or relationship test. The relationship test is all the way down to fourth cousins 4 times removed. Your mother-in-law from 4 marriages ago is still can still meet the relationship test for you. The member of the household would be your friend, your football buddy from back in school, someone who has lived in your house for the whole 365 days, beginning on January 1 and ending on December 31, who is there for proper purposes, not a kept person or a disreputable type of thing. So the person has to meet all the other requirements, plus they have to have been there the entire year. So if your friend gets hit by a motorcycle in January and you bring him in and take care of him and meet all the other tests, you're out of luck because he has not been a member of your household the entire year. Sometimes you meet all the other requirements, but you have not provided more than half of the support. And in fact, no one has. 3 sisters are supporting their mom, each giving an equal third. Instead of just having that exemption disappear, because mom has no income, she doesn't need it, we have multiple support agreement in play. The group, not the individual, gives more than 50% of total support. Once again, remember, for the qualifying child, life's a little easier. As long as the child himself does not pay more than half of the support, then you don't have to worry about this. The group can decide who gets the exemption. The taxpayer getting the deduction must have contributed at least 10% of total support, and you count only people for whom the dependent meets the relationship test. Now I have several examples where we're just going to look at this support test mathematically. So in all these cases, D will be 75, lives with her granddaughter, and D's support will vary from example to example. Right now, D does have gross income, but it is less than $3,900, so she's not out of the game yet. And the granddaughter's putting up another $3,000. So in total, D's living on the lean side. Her total support is $6,000. No one provides more than half the support. And since the daughter did not provide more than half of the support, D would have to claim herself. She's the only one who could use the $3,900. And that would not be tax-wise efficient because she just simply doesn't need the exemption. Her income's only $1,000. Her standard deduction's over $6,000, and her exemption of $3,900. So it's just going to waste. So the granddaughter would have to have spent an extra $1 to claim her. She could go back through all of her records and maybe find a movie ticket or something and say, aha, I now can claim grandma. Here we have more money being thrown in, but remember on the other slide, contribution by D's friend. D's friend does not meet the relationship test because she's a friend, not blood or marriage, and D is not living with the friend. And so while it's nice that the friend has cupped in the extra money, that is only making the situation worse for the granddaughter. So as you can see from this slide, the daughter now needs to, instead of popping in an extra $1, she has to get $501 to cover the $500 from the friend and have the extra $1 to be over. This time we got Uncle Joe in the picture. Uncle Joe would definitely be a relative. So now the life is going to be better. As you see, though, the granddaughter now can claim. Joe's out of the picture because he didn't give more than 10%. But he can count to be the group, right? As long as he is a relative, his $500 counts for the granddaughter. But he can't be in the picture because he doesn't provide more than 10%. So now we finally got into the position where either Uncle Joe or granddaughter could claim the exemption, because in total they're providing $4,000, which is more than 50%, and $1,000 is more than 10%, which would have been $700. So the group does have to decide who gets the exemption. They get to decide each year, and there's a form for that. They have to put that form with the tax return, and everybody in the group must sign. That way, if granddaughter and dad and Uncle Joe both claim the exemption, the IRS will know, because that's one of the computer matches to make sure that a Social Security number is not being used more than once. And it's a very efficient computer match. They don't miss very many of them. The IRS would go to one or both of them and say, you're claiming an exemption you're not entitled to. And they couldn't claim that they were totally innocent, that they didn't understand the rule. So remember, tax evasion includes not bothering to look up the rule. Look at the top of the 1040 when we move on to tax return 5, and you will actually tax return 6 before we get there. And you will see that that type of information needs to be given about your dependents. This is just a reminder about that worksheet that's in the tax return 1 through 4 packet. When you are wealthy, wealthy being defined by AGI at different filing statuses, you have to go through the math to determine how much of your exemptions you get. This math is applied to both the personal and dependency exemptions. So if you lose 20%, you lose 20% of the combined exemptions you otherwise would have claimed. So now to filing status. Married filing joint versus married filing separate. If you are married on the last day of the tax year, you are a married couple, and you must choose married filing joint or married filing separate. And I'm sure you all know that this now does apply to same-sex marriages. The federal government's position is if you were legally married in any state for federal tax return purposes, whether you personally reside in a state that recognizes same-sex marriage or not, you are married, and you must choose between married filing joint and married filing separate. We have an exercise coming up where we will look at the marriage bonus and marriage penalty, and you will see that for income taxes, some same-sex partners won and some same-sex partners lost, because if you're rich and married, it's going to cost you more than if you were single, not married separate, but single and unmarried with the same larger incomes. Head of household has some rules. We have a slide for that. So if you're not married joint, married separate head of household, you are filing single like Thelma has been, and you use the single rate schedules and you take the standard deduction for a single person. This is not an official designation as far as the government's concerned, but it is helpful, I think, to think of dependent on someone else's return as just a separate animal, because their standard deduction is going to be different than if they were a normal single person. And while I'm here, if you are a qualifying widower, that is actually using the married filing joint tables, you'll find that there's an extra column for that. But all it is so sorry about that. The widower, if you, in the year of your spouse's death, you file a joint return. For the next 2 years, you can continue to use the married filing joint schedules and standard deduction if you have a qualifying child. Note, qualifying child versus qualified relative living with you. And then this is just the dollar amounts for the standard deductions. They're pre-printed on the tax return. See that slide for the dependent? We've got tons of slides for that final bullet. But the reason that I say think of the dependent separately is the standard deduction will be somewhere between $1,000 and $6,100. And so since you have to remember that the math is peculiar, it's helpful to think of them as separate. And this is just the 2014 rate schedules. They do get indexed for inflation. They do tend to get a little bit larger each year.